Let's give you the markets update now. The local bourse set to open to mixed markets as investors digest the lower U.S. markets overnight. Meanwhile, there's a possibility of more aggressive interest rate hikes from the U.S. Federal Reserve. We chat now to independent markets analyst Jimmy Moyaha, who gives us his sense of how the JSE is performing in early trade. Jimmy, good morning to you, sir. How are the markets faring in early trade?
Morning, Foley. Morning to our viewers. Markets are mixed in early trade, as you rightly mentioned, tracking some mixed gains overnight from Asia sessions as well as from the US. We know that we saw some stronger than expected US data last week around things like their unemployment numbers and some data this week as well that points to the fact that their concerns over inflation might still linger there, and we might possibly see the US Fed take a more drastic step than what we've heard. I mean, we know that Fed Chair Jerome Powell has come out to say that they might be looking towards softer interest rate hikes and that sort of thing, and that was sort of the first dovish conversation that we've heard from him and from the US Fed in a long time, but it looks as though it might be still too soon to tell. We might have to wait and see what happens there. On the local front of things, markets are tracking weaker markets from Asia, as I mentioned earlier. So Japan was down about 0.7%, Australia down about 0.9%, India down about 0.3%, and so South African markets are starting the morning lower, down about 0.3% on the all share, 0.35% on the top 40, and about 0.9% on the resources side of things. So we should wait and see. On the currency side of things, the rand still struggling to come back towards that 17 rand level since last week. We're sitting at about 17 rand 34 to the dollar, and about 18 rand 13 cents to the euro, and about 21 rand to the pound.
Let's talk about foreign exchange reserves in South Africa. They've increased to 59.88 billion US dollars in the month of November. This is slightly up from 58.7 billion in the previous month. Help us make sense of this data.
Yeah, so the data's been on a gradual rise since we saw it dip. So I think we saw it dip around May. We saw April data topping out at $60.2 billion. And we saw sort of a bit of a pullback since then, but it's been on a gradual rise, and we're basically back towards those April data levels, and hopefully that will be a strong end to the year for us. These reserves are obviously very important for South Africa when looking at South Africa's ability to convert foreign currencies, or ability to hold things like their gold holdings and their foreign currency holdings in an effort to sort of benchmark against the amount of debt that we have and our ability to repay that debt. So higher than expected numbers, always a positive for South Africa, and it's good to see that the numbers back towards the 60 billion mark.
Now, the Q4 APSA manufacturing survey is showing that the manufacturer confidence levels, they remained low. This is amid a challenging outlook. Now, that's a slightly different picture to what we saw from the GDP numbers yesterday. Help us make sense of that. How do we rationalize this?
Yeah, so I mean, if you look at the GDP numbers that we saw yesterday, those came in well above expectations, and we were very grateful. I mean, we can be very grateful and take a lot of comfort in the fact that those numbers were as positive as they were. Now, I did, of course, when we look at the PMI numbers or the APSA manufacturing numbers or the survey there, that points more towards the sentiment from local manufacturers, and their concerns remain largely the same as what we've been seeing from ratings agencies like Fitch, for example, where the concern centers around load shedding, the disruption that is happening from the local side of it, and the impact of that disruption on a long-term basis. The GDP numbers that we saw yesterday pointed to the fact that for private sector manufacturing was on the increase. This is for the first time in 3 months. That was a very positive sign to see, and it does point to a lot more, hopefully going into the new year. But again, from a local side of it, if you have to look at the other factors that are going to hang over these things, are the factors that guys like Fitch have mentioned around load shedding, around the fact that guys like Transnet are going to affect our export numbers as we look to meet export demand. As export demand slows now, despite the fact that China's relaxing some of their COVID regulations and their restrictions at the moment, but demand is expected to remain low now going into the new year. And for the majority of 2023, we are expecting that there won't be elevated levels of demand globally. We're expecting global growth numbers to come in lower as well. And so that speaks to a lot more of what the manufacturing PMI numbers speak to, in that they are looking at the confidence around the manufacturing sector and its ability to sustain itself or maintain levels of production going into the new year as well.
Let's talk about Fitch. That's the ratings agency, at least one of the big ones. They're warning that the findings against President Ramaphosa by this panel, which was established by Parliament, they're saying that this could lead to political instability, and in so doing, it's increasing the uncertainty around South Africa's policy outlook. What's the broader sentiment around this matter, broader market sentiment, Jimmy?
Well, the market sentiment is very much in line with the Fitch read of the situation. If you remember last week when we got the rumors of the announcement or the possibility of the president stepping down, we saw that the rand, as well as equity markets, definitely saw red, and it wasn't a very pretty picture for us. We saw the rand losing ground and has struggled to gain that ground back ever since then. And that just speaks to the level of uncertainty and the level of concern that remains within the market as to whether or not the situation is over, whether or not the situation is being handled, and that sort of thing. And as I spoke to Hugo on Sunday about this, it's not necessarily that the markets and the rand are all centered around the current president, but as Fitch has rightly pointed out, it's centered more around the policies. So, I mean, Fitch also went on to say that if the president were to resign, for example, the potential successor that would emerge would probably or more likely emerge from the current side of the ANC rather than the radical economic side or the Zuma-linked side, as they put it, from their perspective. So if that were to be the case, then Fitch would want to see, is the incoming president going to keep policy the same? Are they going to change around ministers? Are they going to do a cabinet reshuffle? If that were to be a scenario that played out. Now, if that were to play out, and the interim president or the incoming president were to be from a completely different faction of the ANC or from a completely different political party, by way of, if we go that route and that eventually happens, which is very unlikely at this stage. I mean, Fitch has also acknowledged that it is more likely that the ANC will continue to remain in power until 2024, and that is the ongoing sentiment. But it's about the leadership that then comes in if President Ramaphosa leaves. Are they going to change things up? And that sentiment is what's had the market worried and what's had the market spooked up to now. We're seeing now that the market is starting to show signs of potentially calming down, but again, we've still got a couple of things that still are in the works, still happening. We still have that elective conference that's coming up later in the month as well, and so markets are still very cautious at this stage when looking at South Africa to say, from a leadership perspective, from a political stability perspective, are we going to see some significant changes? Are we going to see changes that are going to give concern to the markets, or are we going to see situations stabilize and things go forward? That being said, of course, Fitch has also said that the Phala Phala saga does still weigh in on sentiment and in sort of near-term investment sentiment from a global perspective looking into South Africa. And so this hanging over the president's head is still not a good thing either. So from their perspective, they're looking at the South African situation and saying we need to see some concise and clear direction as to the political direction of the country. Yeah. And from there, markets will also then start to price in whether or not that direction is the continued direction that they would want to see, or whether some changes are going to be needed.
Well, it looks like we might have to wait a little longer, perhaps look at 21st of December. That's when that conference of the ANC would have come and gone. Let's end it off with our favorite subject, you and I, Twitter, facing a new legal fallout from the mass layoffs under Elon Musk's management. Help us make sense of what's going on here. What are the likely implications of this fallout?
there's so many legal cases that are in the works against Twitter at the moment. It is really hard to keep track of them. There's a class action lawsuit, of course, that was filed in early November, if you remember. That's still pertaining to about a couple of hundred of employees that were facing termination and that sort of thing. There's ongoing concerns around the fact that some employees were made to sign waivers to say that they cannot take part in class action suits and that sort of thing. There's new filings now with the labor courts or the Labor Relations Board around employees that were promised severance packages and that were promised that those severance packages will not be affected by Elon Musk's acquisition of Twitter, but since have been affected by those. Some employees are also saying that their concern or their severance packages and their other rewards were linked to things around bonuses, year-end bonuses, and vesting stock options and that sort of thing. And those sorts of things form part of their compensation packages, and that's now no longer being discussed. It's no longer being communicated and that sort of thing. So there's a couple of employees that are outside of the class action lawsuit that have now gone and approached the National Labor Relations Board directly in relation to their conditions or their dismissals. I mean, one of the employees was terminated, and they're saying that it was in retaliation of the fact that they tried to organize a strike with the other workers, even though the strike never took place. So a whole barrage of legal woes for Twitter, and it looks as though there's no end in sight for these. Some of them, they're looking to have them resolved via arbitration, which will obviously be a private process, but the class action lawsuit is obviously going to remain one of the most public ones that we're going to keep our eye on.
Jimmy Moyaha, independent markets analyst, thank you very much for that analysis.